Hello, this is Dan Collins, Editor-in-Chief of Futures Magazine for Traders Exclusive, coming to you live from the floor of the Chicago Board of Trade on Fat Tuesday. An interesting time this year because Fat Tuesday represents the end of a period of excess going into a period of more sober reflection with Lent coming on. And it's kind of interesting because the markets are playing, kind of in a similar sphere right now. Last week, equities made an all-time high. Yesterday, the markets came back. There's a great deal of concern over what's going on in the Ukraine, and the market came down yesterday. And I think volatility is up, and it kind of plays hand in hand with the season we're entering. We've seen this grind up higher to new highs the last couple of weeks during this period of, you may call it excess, and now there's a serious event going on that's causing people to pause and the market to come down a little bit, similar to the season. If you go to futuresmag.com, you can see a piece written by Jeff Greenblatt pointing out that last week, going into this week, was an important time window, 260 weeks from the March 2009 low. So it's an odd thing, but he has pointed it out in several stories he's written for us over the years, how some of these geopolitical events just seem to come along during important time periods. And it's a battle between the fundamentalists and the technical side, but it shows that usually you have to give more importance to these issues when you're at a very, very important turning point in time. And you can kind of go back and look at some of Jeff's previous work on time cycles. He's really been on the money. What does that mean to the trader? Well, it means you need to be aware. In the upcoming issue, we're going to be speaking with Mark Spitznagel, who's one of the most successful tail hedgers, and it's a strategy everyone in some fashion needs to look at, because as we've seen throughout the 90s, even though people may believe the markets are going straight up, and even though people may believe that they're overpriced, we know that can happen for a long time. That can persist. So you can't just, say, I think it's going to turn, I'm going to sell, because you can get eaten up while it happens. But at the same time, you can profit from a continuing rising market, but protect yourself from a sharp downward move that many people, both fundamentalists and technicians, can believe can happen soon. So I mean, the answer is to continue to have exposure to the market, but by having some sort of a tail hedging strategy, not be hurt if a sharp correction comes down. It's time for, as we enter Lent in 2014, on Fat Tuesday, it's a good time to kind of reflect on that and look at that market and be a little bit more sober. We don't want to completely be out of the market, because we know during these times, especially if you do believe the market, may be overpriced, that's often when you see the largest move before some sort of correction happens. So you don't not necessarily want to be out, but you certainly want to be protected. Some sort of tail hedging strategy is the way to go. This has been Dan Collins, Editor-in-Chief of Futures Magazine for Traders Exclusive. Happy Fat Tuesday.